So, Robert, the Conference Board released information today saying the leading index is up 1% for January. Can you put that number into perspective for us? What does that mean?
Yeah, that's a nice strong number. Anything over about 0.2, 0.3% is a good gain. And the Conference Board actually produces three key indexes: the leading index, which is the one that gets all the headlines; the coincident index, which tells us what the economy is doing right now; and the lagging index. And the good news in January, and we've seen this a lot in the last several months, is that all three indexes are up. And when all three are up, that's a very solid economic indicator.
Also, the Fed released minutes from its last meeting, and then we also have an upcoming meeting with the Fed. What did you glean, first of all, from reading the minutes?
The Fed right now is really trying to come to terms with how it deals with inflation. Price stability is one of the so-called dual mandates of the Fed: maximizing employment within the context of price stability. So we brought the unemployment rate down 4.1%, probably going to go even lower. So the Fed has accomplished that part of its mission. But as the unemployment rate goes down, we tend to see wage hikes. We tend to see that translating into higher price levels. And so that inflation component of the Fed mandate right now is very much front and center on the Fed's mind. They spent a lot of ink in these minutes here talking about different ways of measuring and modeling inflation and what the various members think. And that's a very open and active discussion. And the reason why that's so important is that's going to inform us about what the Fed wants to do with rate hikes over the remainder of this year and into next. And right now, it still looks like the Fed is on track for at least 3 rate hikes this year. But we're going to get some key information coming up at the next Fed meeting. The next Fed meeting, March 21st, we are expecting a rate hike, but we're also going to be seeing the dot plot, which gives us forward-looking expectations of the various Fed members, new economic projections, and there'll be a conference, the first conference by new Fed Chair Jay Powell. So it's his sort of introduction to the world in his new capacity as chairman of the Federal Open Market Committee.
There's also been discussion about would we see 4 rate hikes or 3 rate hikes, but we don't know at this point, correct?
Yeah, I'd say the conservative assumption right now is 3. But I think you can also make a case for 4, and I would say that the probability of a 4th rate hike this year might be someplace around 1 out of 3. And of course, as we go through the year, it could go up, could go down. But early in the year, I think there's at least a 1 out of 3 chance we get 4 rate hikes this year, not 3.
Robert, let's move on to real estate. Over the past few weeks, we've been talking about 30-year fixed rates going up. We're learning it went up again, and also existing home sales decreased in January. Is there a correlation there, and what are your thoughts for the future?
Yeah, and this sort of can link back into the Fed, of course, because we're talking about them raising the Fed funds rate, which is the benchmark short-term interest rate. That will have an impact on longer rates, including mortgage rates. We're seeing 30-year fixed-rate mortgages going up. And in January, we saw existing home sales falling by a little over 3%. We can't make a correlation on just 1 month's worth of data because there's a lot of volatility in that series. But I do think there is some vulnerability in housing markets, particularly for those first-time buyers who are really saving their last pennies to qualify. And with both fairly steady increases in prices right now and increases in mortgage rates, housing affordability is declining, and that could be a headwind for first-time home buyers this spring.
Moving on to unemployment insurance claims in February, those are down, and are those reaching historic low levels at this point?
Those are some of the best numbers since Nixon. That's sort of the way that really captures that series. These are very, very low numbers. We have very tight labor markets. We're going to see the unemployment rate going below 4%. And any way you slice it and dice it, very good labor market indicators, very low unemployment rates. And I think it's a good bet that we're going to continue to see upward pressure on wages, which tends to squeeze corporate profits, and that puts upward pressure on overall prices. So it goes from a tight labor market to higher wages to higher overall inflation, and that's what the Fed's going to be keeping their eye on through the course of this year.